Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today with our weekly wrap-up. Graham, what happened in the market last week?
Yeah, thank you, Stacy, and thanks for our listeners being on the call. I think we had interest rates kept pressure on equities, even though they staged a pretty good rally on Friday, based off a stronger than expected job report. So you might think that that would be a little opposite. But we saw the Russell 2000 index did slump 2% for the week. Now that's down more than 12% below the July peak. We did see the Nasdaq Composite gain about 1.5% and the S&P 500 rise about 0.5%. So 8 of the 11 S&P sectors finished down. What was the worst one? We saw crude oil selling off, coming down about 5%. And that was off no real news from OPEC, no change in policy or anything like that. If we look at, start getting some economic numbers and what was causing some of this, we saw really strong employment numbers. We saw new jobs. We were up about 336,000. Now that was double the expectation, putting some fear back in the market that maybe the Fed's job is not done. But at the same time, we saw some cooling wage reports, and we saw those cooling wages in some of the lower paying leisure and hospitality areas. Again, keeping some of that wage growth in check, calming the market's temperament down a little bit on that really strong employment report. So oddly enough, we saw full-time employment down about 700,000. If we look at some other economic news, we saw the U.S. manufacturing industry kind of showed some signs of improvement for September. The ISM PMI reading remained in contraction territory still. If we looked at the U.S. trade deficit, still shrank for about 3 years. If we go overseas, we looked at the Bank of Japan, said, listen, they're still going to buy bonds as needed to maybe slow the rise in yields. If we looked over at Australia, their Reserve Bank kept rates steady again. Now that's for the 4th consecutive month, but they did hint that they're going to do what they have to do if they see inflation kind of rearing its head again. If we go over to Japan, we saw the PMI survey revealed some pretty increasing, I'm not going to say strong, but increasing economic output. And some external demand remains still quite a bit sluggish over there. Now, with the high rates over in Britain, we really saw their construction activity really plunge. I think we got back all the way down to 2008, 2009 numbers for a home building. Probably some pressure that we're seeing just like we are over here in the States.
Okay. Well, what do you think are the key factors contributing to the recent fluctuations in U.S. equities and bond markets?
Well, I think the story is all about yields correcting. Right. So remember, we've made statements. Everyone that's listening to the call probably knows we've talked about inverted yield curves. Well, I think that curve is making an effort in a short amount of time, like a week and a half, and it's moved huge to try to reinvert, meaning you get paid less on the short end of the bonds that own compared to the long end, where it's kind of been the opposite, right? So it's trying to reinvert, it's making a great effort at it, and I think that's putting the drama in the market right now.
All right. Do you think that the Fed is likely to implement additional rate hikes, and how might that affect the financial markets?
Well, I think they said they're going to do what they have to do to get inflation down to their mandate. Now, is their mandate truly that they keep stating, or are they going to loosen up on that? I think at the end of the day, they're just not going to show all their cards until they feel like inflation isn't going to double back on them. Inflation has come down from 9 and change from mid-year last year to just over 3%. So it's come down a long ways, but I don't think it's quite where the Fed wants it. But I think with these rising yields that have been so dramatic and this reinverting of the curve is doing a lot of the Fed's a lot of the job for the Fed.
All right.
Yep.
Well, I guess we'll see. Thanks so much, Graham.
You got it.
And thanks to our viewers for joining us again today. We'll look forward to seeing you next week on our weekly wrap up. And until then, have a great week.
Take care.